Welcome back to the deep dive. Our mission today is really laser focused on you, the professional, the entrepreneur, anyone managing a team who depends on global infrastructure to
Oh.
get work done.
Hmm.
Because when you're on a long assignment abroad, where you work, where you live, that's not a luxury. That's operational continuity.
It's everything. And today we're diving into a set of sources that, well, they really reveal just how fast that entire landscape can shift under geopolitical pressure.
Yeah.
We're looking at it through the lens of one huge business decision, one that tells us really everything we need to know about navigating risk in 2024.
We are looking at the extended stay and serviced workspace sector. The industry providing those flexible offices and temporary hubs for you when you're deployed overseas.
Right?
And we're deep diving into the decision by IWG, that's the powerhouse behind brands like Regus and Spaces, to basically pull the plug on all their operations in Russia.
And this is so much more than a simple business withdrawal. This action, which was confirmed by the founder and CEO Mark Dixon, it's really a masterclass in modern geopolitical risk management.
Okay.
So our job here is to unpack the why, the how they're doing this, and, most importantly for you, what this tells us about the resilience and some surprising pricing trends in the rest of the international market that you depend on.
Okay, let's unpack this. So let's start with the hard facts. IWG, and we should say they're the world's largest serviced office provider by a pretty significant margin.
Oh, huge margin.
They've confirmed it. They are completely exiting the Russian market. That means closing all 9 of their existing workspaces across the country.
And it's not a pause. This isn't a reduction.
No, it's a full operational divestment.
Exactly. And, the venue for the announcement is almost as telling as the decision itself. Dixon confirmed all this at the MIPIM Property Conference in Cannes.
Which is one of the biggest real estate gatherings in the world.
The biggest, yeah. Announcing a full exit at a high-profile industry event like that, it just sends an immediate, unmistakable signal to every major institutional investor, every corporation out there.
That this is an ethical and political decision first.
Right. It overrides any commercial consideration. It's a statement that rings across the entire sector.
But this is where the logistical nightmare for a company this size must begin. You mentioned it isn't like an immediate shutdown. Dixon was clear they're pulling out gradually. And the whole timeline is tied to the expiration of current leases.
And that phrase, expiration of current leases, that is the absolute key technical nugget here. You have to understand, in a highly sanctioned environment like Russia, you can't just break commercial leases.
Right. Especially if the landlords are local Russian entities.
Exactly. IWG runs on franchise and lease agreements. Trying to exit those contracts immediately, especially when you have restrictions on foreign currency transfers, could just lead to these long, expensive, legally messy disputes.
So their hands are kind of tied by the paper trail of their own expansion. They have to wait for the contracts to just, naturally unwind.
Yeah, which could take years in some cases. It's about ensuring an orderly, compliant exit rather than a chaotic one that could trap assets or even personnel.
Wow. So that really turns the exit strategy from a sprint into a very, very deliberate marathon.
It does. And it underscores a crucial point for you, the international professional. Even when a corporation makes this big ethical decision to leave a market, the complex web of real estate law and local contracts, that dictates the pace. This delay is just an unavoidable cost of global complexity.
Now, despite all this ethical weight, Dixon did characterize their Russian footprint as a small business. It was expanding, but financially it wasn't some cornerstone of the IWG empire.
And that context is vital. It means the decision wasn't financially, seismic for IWG, but it was massive strategically. They halted all planned investment.
A clean break.
It's a clean break, rooted in principle. It shows that the risk, the brand risk, the geopolitical risk, the ethical risk, now just completely outweighs any potential of that market, no matter how small its current financial contribution was.
The fascinating structural implication here is this isn't about asset optimization. This is moral divestment.
Absolutely.
So this is where it directly impacts professionals like you.
Yeah.
We have to look at who is actually using those 9 offices. IWG's offices in Russia, it was explicitly noted, primarily catered to international corporations. These weren't just, the local startup scene.
No, these were the foreign corporate teams, the ones needing flexible landing spots for long-term projects or, regional management.
That's right. And so IWG's exit creates this huge logistical ripple effect for any of those international businesses still there.
It does.
Mm.
Our sources confirm a lot of these big corporations were already reducing their footprint in Russia because of sanctions and just general instability. So the loss of a reliable, globally standardized provider like IWG just makes everything that much harder.
Right. Think about it from your perspective. You're a professional on a multi-month deployment. You're running a regional project. You rely on serviced offices because they offer instant, reliable infrastructure.
Quad, Wi-Fi, secure environments, familiar standards. You know what you're getting.
Exactly. When that reliability is suddenly just pulled out from under you, it forces an immediate crisis. The affected businesses now have to either, cease operations in the country entirely? That's a huge decision.
A huge call to make. Or they have to scramble to find alternative workspaces, which are now going to be fragmented, harder to vet, and probably non-standardized.
This just underlines the absolutely critical role that flexible workspace providers play in global corporate mobility. For those of you who frequently need to find flexible, secure, and ready-to-go spaces for extended stays anywhere, you know how dependent corporate deployment is on this underlying infrastructure.
And when a major standard setter like IWG leaves a market, that stability just vanishes instantly. It forces corporations to rely more on smaller, local providers.
Which means more vetting time, more risk.
More risk, especially in operational security. The geopolitical risk doesn't just affect the company leaving, it drastically raises the operational difficulty for every single company that decides to stay.
We do need to make sure we cover the full scope of IWG's response, though, because it wasn't just about the exit.
Yeah.
While they were pulling out of Russia, Dixon also made a point to highlight their efforts to proactively support businesses that were directly affected by the conflict in Ukraine. It was a kind of simultaneous push and pull.
It was a clear demonstration of operational triage, really. Crisis response. Our sources detail how IWG used its global network to help companies that could no longer operate safely in cities like Kyiv.
So they were providing a corporate lifeline.
Essentially, yeah. Helping those teams pivot and set up new operations quickly, and in many cases, they were waiving the initial setup costs.
And the places they relocated to, the destinations Dixon mentioned, they're incredibly instructive. They tell you a lot about where the international business community sees stability now. He listed Poland, Romania, and Portugal.
And this tells us two things. First, immediate proximity matters. That's why you see Poland and Romania.
Right, next door.
They're stable, they're NATO-aligned EU members, and they have existing deep business ties to Ukraine. That makes moving personnel and getting set up relatively straightforward.
Okay, that makes sense. But Portugal, that seems, a bit further afield for that kind of immediate operational triage.
Portugal reflects the need for deeper, long-term stability and access to high-quality labor pools, digital nomad visas. It's an established, attractive Western European hub.
So it's a safe haven.
It's a long-term safe haven for teams that need to completely rebuild their presence without that fear of immediate conflict spillover. So you see this pattern. Immediate, regional relocation paired with these long-term Western European anchor points.
That's a really rapid regional reprioritization of corporate presence, and it's all driven by security and compliance. It brings us back to that fundamental question of, corporate calculus in extreme times.
This raises an important question. What does it take for a global company to navigate compliance, business ethics, and just continuity when borders are this volatile?
Yeah.
Dixon's reflection on it was pretty stark. He just called it, obviously, a very difficult situation and concluded that closing the Russian business was simply the right thing to do.
So it wasn't just about minimizing losses.
Not at all. It's about signaling core values to your global customers, to your investors. It's setting a precedent for moral calculus in infrastructure deployment.
And if the global standard setter acts this way, it really pressures every other competitor and, frankly, every corporate user to evaluate their own risks.
That's the strategic takeaway for you. When you choose a provider for your extended stays or your corporate deployment, you aren't just vetting their facilities anymore. You're vetting their ethical resilience, their compliance posture under extreme pressure.
The cost of geopolitical volatility has to be factored into how reliable you think your partners are. Okay, now let's pivot away from the conflict zones for a minute and look at the broader global market picture. If IWG is taking a hit by exiting Russia, how is the rest of the serviced office industry, the infrastructure you rely on for these flexible corporate stays, how is it faring?
Well, what's fascinating here is just the sheer resilience of the global market outside of these geopolitical flashpoints.
Okay.
IWG is reporting a decidedly positive trend in global occupancy rates. Dixon gave some specific numbers. Occupancy has returned to approximately 75%.
75%. Okay, let's put that number in context for everyone listening. Before the pandemic, the gold standard for occupancy in this sector was somewhere in the 80 to 85% range.
That was peak performance.
So hitting 75% now indicates they are genuinely getting close to those previous peak levels. The demand for that flexible, reliable workspace to support teams abroad is, well, it's surging back.
But we need to look closer than just the percentage. I think the nature of that occupancy has fundamentally changed.
How so?
Before the pandemic, that 80–85% was often driven by large corporate teams signing these long-term commitments. It almost mimicked a traditional office lease.
Okay, so the 75% today is different.
It is. Today's 75% is driven by the hybrid model, by increased corporate deployment. Companies are using these serviced offices for shorter, more frequent deployments.
So higher churn, but maybe higher yields.
Exactly. Higher yields per occupied desk. You could argue this new 75% is actually healthier and more profitable than the older 85%.
Yeah.
It's entirely focused on the flexible, short-term deployment model that you, the global professional, actually need. It validates the whole concept as essential, not just supplemental.
That is a really critical nuance. Demand is strong, and it's being driven by the very people who need that flexibility. Which I guess leads us to the other major signal the company reported, pricing.
Correct. The company said that pricing has also increased. And they attribute this specifically to the fact that they are, and I'm quoting, no longer offering discounts to its customers. When you see the dominant market player just confidently eliminating discounts, that is a very, very strong indicator of robust recovering demand and confidence in the entire model.
This is really the financial punchline for you, the listener. If you are used to securing those, favorable multi-month contract deals a few years ago,
Those legacy discount structures are likely gone across the board.
the market has tightened. It's tightened because demand has recovered, and it's now structural. It's not temporary.
It shows that corporations and professionals are willing to absorb higher costs for that convenience, that compliance, that guaranteed infrastructure. They are paying a premium for flexibility and immediate availability.
That flexibility isn't being treated as a negotiable perk anymore.
No, it's a necessary cost of doing business globally.
So what does this all mean? Let's try to synthesize the key takeaways for you, the professional who is actually relying on this infrastructure. The global systems supporting international business deployment, like serviced offices, are showing two extreme simultaneous realities.
They really are. On one hand, you have this intense geopolitical volatility. It's forcing major providers to make these difficult, principles-driven exits, which just cripples infrastructure in those conflict zones.
And on the other hand,
outside of those areas, you have strong structural demand that is driving up occupancy. And, critically, it's eliminating those historical pricing discounts. This dual reality just defines the current state of global corporate infrastructure.
the demand for flexible, safe, and reliable solutions remains critically high, and that is what's driving prices up everywhere else, even as these major providers are making huge ethical decisions about abandoning entire markets.
So you need to recognize that the cost of your corporate mobility is rising. It's rising because the market has successfully absorbed the hybrid work shock and is now catering specifically to that high-value, short to medium-term deployment. The age of deeply discounted long-term stays is quickly receding.
And that brings us to our final provocative thought, which really builds on this tightening market data. If the global recovery in the service office market is driving prices up and getting rid of discounts, how will corporate teams who rely so heavily on these spaces, I'm thinking especially for months-long projects in high-demand hubs, say, across the Asia-Pacific region, how will they need to adjust their budget and planning strategies?
It's a huge question.
If your team used to budget X for a 3-month setup in Singapore or Hong Kong, you now have to assume Y because those legacy discounts are just gone. The market is less flexible on price, even while it demands maximum flexibility in space. You really need to factor the financial implications of this market tightening into every single international deployment plan going forward. That is definitely something to mull over before your next long-term assignment.